Well, good morning, everyone. How you doing? This is Buddy from Bali. And there we go. Oh, almost. How's it going, guys? Oh, we got our spreadsheet going here. We've got some stocks to look at, but before we get into that, I want to say thank you guys we've got over 200 subscribers now. Not bad for only doing this for a couple months. We do mostly use the wheel strategy on this live option show. We teach people how to use options. Good morning, Alyssa Brown. And I want to go back to, we kind of breezed through this last time. By the way, happy new week. I hope you guys had a good weekend. Happy Father's Day on all that. Last Wednesday we talked about, should we be trading for cash or should we be trading for stocks? And I mostly was talking about now that we're in an inflationary environment, or rather now that we're in an environment where everyone agrees there's going to be large amounts of inflation. I've said for years that inflation was well above CPI or whatever the government puts out, at least double in my opinion. Because I remember when gasoline was $1, milk was $1 a gallon also. And then I haven't been in the U.S. for a few years, but last time I remember milk was about $3 to $3.50 per gallon. And you compare that to when I was a teenager, that is not a 2% growth, even with compounding. I think it worked out to about, when I calculated it, 4 or 5%. And then you have to calculate everything else that you eat, drink, and use on a regular basis for inflation. But even without inflation, when I started trading, my goal, of course, was to get more cash. But now that I've sort of experienced stocks more, really understand what stocks are, really have companies that I believe in the long term, I'm starting to shift and transition to wanting to trade to acquire more shares, basically to end up with more stocks, because in the long run that's going to be better and safer than cash. Cash is a depreciating asset, whereas stocks, if you're in a good company, are going to be an appreciating asset. And you do need to rotate once in a while, but basically in the long run, you're going to be better off with more and more stocks that you can get a hold of, owning more and more companies that you can be a part of, and appreciating and watching your wealth grow and build. Whereas if you just stack cash, yeah, that gives you more money to trade options with, but is that the real goal is to just, I mean, obviously we all want more cash, but I don't know. I think you're better off having the right stocks and lots of it, especially if you get really bullish on a stock like Tesla or something similar. You do a lot of research and you have a lot of potential upside rather than just having more cash. But I want to talk to you guys today and find out, what are your goals? Where are you guys from and what are your goals? And the reason I think a goal is so important, especially when you're starting out in trading, is because it lets you know when is enough enough. For example, if you were given if you were given a choice of going YOLO into a stock that might make 300% or lose it all, or you could do some cash secured puts for 5% a month, which do you choose? Well, that's going to depend a little bit on your risk tolerance, but also, what is your goal? You know, do you need to make 300% in a month? Do you care if you lose it all? What percentage of your portfolio are you willing to lose on that YOLO? In other words, it's not about just making money. Making money is not a good goal because it doesn't give you any direction when you're trading stocks and when you're in the market. Okay, I want to make money. Well, there's only 1,000 different strategies to quote unquote make money. So which of those do you choose? You need a goal that helps clarify your direction and lets you know that, like, oh, because this is my goal, I'm not going to look at these strategies over here, and I'm not going to look at these strategies over here. I'm going to be pointed clearly in this direction. Because you imagine, you got 360 degrees, and you can get anywhere in the world if you just go around enough times, right? Let's say you're in America and you want to get to Africa. Well, you could go across the Pacific. That's a direct line. That's going to get you to your goal very fast. Or you could go up, fly over the Antarctic, and then back around to the Australia, and then come to the other side and end up in Africa. Okay, clearly one of those is a better route to take, but you have to know clearly what is your goal, where you're trying to get to, and what you're willing to do and what you're willing to do along the way. So anyway, I personally have a goal. My goal is to make 25% a year. 25% a year, minimum. And I say minimum. You can't predict what's going to happen in the markets, but if I'm ever at a point where I'm not consistently meeting that minimum goal, then I should consider going back to real estate, okay? I've done Airbnbs, I've owned a commercial property. Those things have their pros and cons, but I like trading stocks. I can do it anywhere in the world. I don't have to deal with my managers. I don't have to deal with my cleaners. I don't have to deal with customers. I'm literally trading stocks and letting some other manager run their company and manage the money better than I can, basically. And when you're selling options, you're not even doing that, right? You're really just selling options. You're trading to the market. You're taking advantage of other people's YOLO goals, right? And then you're collecting premium every single month, and you don't have to talk to a person. You just click buttons, and I really find that really beautiful. I don't know why. For today especially, you ever guys get this? You ever just like feel super anxious and impatient and grumpy for no reason at all? That's exactly what I was going through today. Not very nice to my staff, not very nice to the people I'm interviewing to join with my companies. But it's just one of those days, and I really just didn't want to be around people today. I did as little of that as possible, but some days I like to be around people a lot, and some days I just don't, and today was one of those days. What do you guys do when you have one of those days and you don't know the cause? You know, it's not like I had a big back pain or anything major, or there's nothing triggering my anger and grumpiness and just my mood to not be around people and not to have any patience today. What do you guys do when you're in that mood? What do you guys do to get out of that? Anyway, we'll get back to this. So my goal is to make 25% a year minimum, but my real target, what I'm really trying to get, is 50% a year. In order to get 50% a year, I know it sounds like I'm just going on a train here, but in order to get 50% a year, I got to shoot for higher than 50% a year. And I kind of look at what the market is willing to give me, and it came out much higher than I anticipated last year, after COVID till now, basically, which was a very much of a bull run. Okay, I'll admit, I was able to get mostly 4 and 5% monthly returns on my options. Okay, that's selling premium, specifically cash secured puts, and compounded out, that actually works out more. You would think, well, 5% times 12 is going to equal 60%, but of course that's not with compounding. When you compound it out, you come out closer to about 80%, which was phenomenal return. I'm hoping we can keep doing that at least during these bull cycles. Okay, but when all said and done, from June to February, it worked out to about 70%. I don't know what it is now. I think it's actually less than that. I think we're down actually to about 60% because of the pullback that we had in March. And then we've made up the distance on some of that. But that's what my goal is. That's what I've been able to achieve. So I succeeded and I beat my real goal. My real goal is over 50%, 25% minimum. If I'm not hitting my minimum, then I have to completely rethink my strategy and maybe even leave stock trading, or at least temporarily till I figure out a better strategy, because I'm not even meeting my minimum goal. My real target was 50%. We got about 60 to 70%, so I am doing that. Why do I keep talking about this? Well, what is your goal, right? If you have a goal of making 300, 400, 500%, is that even reasonable, right? Is that something that can be repeated? And how are you going to get there? Or is your goal, closer to my goal, maybe 25%? Maybe 25% is your real target. Maybe you'd be happy with 15%. That's going to change the strategies and the options and the strikes that you're going to want to look for and choose, okay? And you see people, and it's very easy to get distracted with people making money on crazy stocks or crazy strategies or crazy plays. There's an entire Reddit dedicated to it called Wall Street Bets, which is about what used to be, now it's mostly about pumping GME and AMC, and it's basically turned into a decentralized pump and dump I don't want to say scam, but a pump and dump group, okay? Most pump and dumps are run by a select few individuals who form a group. They get other people excited and into it, and then they're going to pump it up, and then they're going to sell first, and then it starts dumping, and then they're going to tell their their followers to sell, if even. And then it's a very easy way to get scammed out of money. It was really big in crypto in 2017, the pump and dumps, okay? And that's kind of what I feel like what Wall Street Bets has become. But Wall Street Bets used to be a place where you could go and just find out and see crazy wins and crazy losses off of these crazy bets. That's why it was called Wall Street Bets, right? It used to be a place where you could just see the outcomes of these crazy strategies. But now it's mostly turned into, I feel like, just an echo chamber for constantly pumping the same stock over and over again. But what happens is you see that going on over there, and you start to go, is my strategy wrong? Maybe I should try this, or maybe I should try that. I want you to consider, of course, survivorship bias. Survivorship bias. Okay? Which is the idea that we hear the stories from the people that succeeded. We hear this a lot, especially in entrepreneurship, people who started a company. Yeah, you hear about how great it is, how everything went wonderful, they made tons of money, maybe they had some hard tribulations and trials, but eventually they got through it and they succeeded and now they're rich, okay? What you don't hear about is all the couples that went through divorces and broke up and had to split their company and sell their company or have their company get taken away or all this other stuff. You didn't hear about all the people who had family problems that completely ruined their lives. You don't hear... Right? Those people are not out selling books and running courses and being on radio stations. So you don't hear, when somebody wins, they want to tell the world, right? They tell everyone, right? But when somebody loses, they crawl into a hole and disappear, right? They don't tell anyone. They don't want the shame. They don't want to hear about it. They don't want the pity party. And so you end up with what's called survivorship bias. And so if you're feeling like, oh man, this strategy is good, at least I thought it was good, but look at those people over there making all that money, remember that you're hearing survivorship bias. You're hearing the people that actually did make a bunch of money. For all the people that made money in GME, there has to be a bunch of people who are losing money in GME, and it's not just the people shorting, it's the people who bought when it was here, and then it dipped, and then they sold, and then it skyrocketed again. Somebody else bought that dip. Well, somebody had to cause the dip to happen. Somebody had to be selling and losing money on GME. Of course, they're not going to go around bragging about how much money they lost on GME or AMC, or I'm just picking on these stocks because they're the hot ones right now. It could be any stock. It could be any strategy at any time. You're not going to hear about the big losses as much, okay? People want to talk and brag about their wins. They don't want to go around making a bunch of posts and memes and stuff about their losses, which was actually, coming back to Wall Street Bets, that was a nice thing about Wall Street Bets, is people did air their losses, and we could see that, and we can see how much money they lost, and it was about this crazy ride and experience that you have. I was actually a big fan of Wall Street Bets. I just don't go there anymore because it's just the same posts over and over again. It's just an echo chamber of picking the same stocks and trying to pump them and dump them, okay? It's 9 o'clock. We've got about 30 minutes before the opening bell. We're going to start to take a look at some stocks here. I do want to remind you that part of the reason I do this channel is to promote the end of aging. I don't want aging to happen to me. It's happening every day. I'm 38 now. I still feel and remember what it was like to be 16. But I'll tell you what, my body, my joints, my knuckles, my ankles can't do the same things that I want to do. And we don't have to be like that. We've made huge advances in computers and rockets and flying and everything else, but we don't put enough time and effort into biology. We spend a lot more money on bombs and weapons and controlling people. We need to spend more time and energy on biology, okay? So part of the reason I do this is to say, hey, look, go check out the SENS Research Foundation. It's a non-profit organization you can donate to. You could join, you could help, you could do something, and we can help. I think a really big thing is if we can reach out to kids and get them more and more interested in science and biology, that's going to help everyone in the long run. Whereas, too many people are becoming politicians, lawyers, and traders. But, I've ended up where I am. It's a little late, I think, for me to get into biology. But do check these guys out. If you're looking for a way, after you get rich, after you make tons of money using my strategy or whatever strategy you use, what are you going to do with that money that's really valuable in changing the world, making the world a better place for everyone else, but also good for you, right? If this works, you're going to benefit from this as well. So do go check out sens.org. the nonprofit foundation that they are trying to cure aging. Also, not a nonprofit, this is a premium subscription service. TheOptionsOracle.com provides a monthly newsletter with option picks. They just had a option newsletter come out yesterday with about 5 or more picks on it. And you could have signed up for a 30-day free trial and gotten those picks. You might as well sign up right now and make sure that you're on the next one. Sometimes they have 1 or 2 during the week, or they might be closing something early or something like that. So just get involved. You're not going to miss the next newsletter if you sign up today. They've got a 30-day free trial. And then after that, it's only $97 a month. Well, guess what? If you get just one good pick from them, excuse me, you're going to make $25, $75, $95, $100 per contract. So even if they give you just one good pick, you could do 5, 6, 7 copies of that contract and make $500, $600 and use the $97. Use part of the $500 to pay the $97 fee for the Options Oracle. So go check them out. They're really great. I've been using them for over a year, and we are affiliated with them. All right, I'm going to get into the stocks really quickly, but just in case anybody's new that's watching, I want to tell you guys that the wheel strategy is simple, but of course there is nuances. There's devil in the details, but the basic concept is this. We're going to find a company that we like, and we're going to write, that means sell, it means short, it means all the same thing. We're going to write a cash-covered put, cash-secured put, cash-covered put. There's a lot of different words that mean the same thing in the financial industry, okay? We're going to go out, we're going to find a company, and instead of buying the put and hoping it goes down, we're going to sell that contract. We're going to be the creator or the seller of that contract, so we're obligated to buy the shares if the price goes down. Now, I had an interesting conversation with someone that I was trying to teach this strategy to, and they missed this part, and they missed why this part was so important and why we start there. And he was like, oh, I like this strategy. I'm going to start doing stock covered calls. And I'm like, okay, yeah, you kind of got it, but why did you do that? Well, it's safer. No. Okay, no. Look, there's reasons that you might want to do a stock covered call as your starting point, but it's not because it's safer. Because it's not safer. It's fundamentally and mathematically not safer than starting with a cash covered put. So I'm going to run you through an example, okay? Let's take a company, let's just call it XYZ. Let's say it's trading at $50 a share. If you want to do and start the wheel with a stock covered call, you would have to go out and buy shares at $50 a piece, then use those shares to sell a covered call at some price. Let's just go ahead and just make up a number, and let's say you're going to sell the $52 strike and you're going to get $5 in premium, which would be actually amazing. That's over 10%. It's a little bit under 10%, okay? But you now have, quote-unquote, a cost basis of 50 minus 5. Why minus 5? Because you got $5 in premium. So your cost basis now is $45. And if it goes from 50 to 52, you will make $7 a share. Everyone got that? You make $7 shares. Why 7? You get to keep the premium. You got the premium up front. You get to absolutely keep that. And if it goes above, if it goes above 52, you will get the $2 when it gets sold, because you bought it for 50, then it's getting called away at 52, so you're selling at 52. When you write a covered call, you're agreeing to sell the shares at that strike price, so that you're getting to keep that extra $2 plus the $5 in premium. This is great when the stock goes up. This is great when the stock goes up. It's a very bullish play. Okay, even though you're selling a call, it might seem like, well, if you're buying a call, that's going long and that's a bullish play. That's actually the same. When you're selling a call above your strike price, that's still a bullish play, okay? But, and this is great because you just made $7 in 30 days because the stock went up and you got your $5 in premium, okay? It's fantastic. Nothing wrong with this, okay? But it is not safer than a cash secured put, and I'm going to explain why. Say instead you didn't buy the shares, you sold the $48 strike, okay? And again, we're going to say you collected $5 in premium. These are just made up numbers, okay? Now, what is your cost basis? Well, it's not 50 minus 5 because you didn't buy the shares yet. You're agreeing to buy the shares at 48. So it's 48 minus 5, giving you a cost basis of 43. Remember, the cash covered put guy had 50 minus 5, so his cost basis is going to be 45. Okay, you are $2 cheaper than he is if the shares go down, and this is where it's important. Now, if it goes up, let's just say it goes up to 52. That's great for the call buyer. He's going to make $7. It's good for you. You're going to make $5, and you can close early. The guy who sold the covered call can't close early to collect those profits. He has to wait for it to expire. So that's the advantage of the cash secured put. You can close early and collect most of your profits, okay? But you're locking in. That's the max profit you're going to get. You're going to get $5 a share because that's the premium that you collected on the cash secured put. It's just a matter of when. How fast do you get it? Now, so we just described why it's safer, okay? Let me just clarify this just a little bit more, okay? You have a cost basis of 43 as the cash secured put seller. That means that if it goes down to $44, the guy who did the covered calls, he's going to lose money. He's still going to have his shares, but he's losing $1 per share now. You, on the other hand, get to collect all of the premium. Now you're a little bit down below the strike price. What did I say the strike price was? 45, right? Oh, no, I said it was 48. Sorry. Said it was 48 and you got $5 in premium. So you will get assigned the shares, but now they're worth 44. Your cost basis is 43, so you can immediately sell the shares and collect $1 in profit. Whereas the guy who did the stock covered calls, he's going to lose money. His cost basis is 45. He's losing $1 a share, you're making $1 a share. Now this gets even more out of whack, okay, when you start dealing with much further numbers. Let's say you sold the 45 for 5. Your cost basis is going to be 40. His cost basis is again going to be $45, 50 minus 5, okay? What happens when the stock goes down to $30 a share? Well, you're going to be $10 below. He's going to be $15 below. He's going to be 50% higher in price. It's going to be 15 instead of 10, okay? Or his losses are going to be 50% higher, you should say, okay? The point I'm making with this is for him to get back up to break even, he's going to have to climb $15 to get there. You're going to only have to climb $10 to get there. It's going to be much easier for you to break even. When you have, and here's the other important part, one more thing, and then we're going to go look at stocks, I promise, okay? Whoever has the lower cost basis is going to be easier to sell near money stock covered calls for the most premium. Let's go back to the example. Let's say it's 45 and you you sold the 48 put for $5 in profit, in premium. It's easier when I have this all in a spreadsheet in front of you, but I didn't have that ready for you guys, okay? So his cost basis is 45, yours is 43. Let's say the stock drops down to $40 a share. You're going to have a much better time selling your covered calls at or above 43, earning serious premium. He's going to be $5 out of the money. He's going to make a lot less than you. And if it goes even further below, you run into a scenario like, let's say it's $35 a share is the current price. Your cost basis is 43. His cost basis is 45. You might still be able to sell the $42 or the $43 covered call for a good premium. At the 45 versus the 35, he's going to be getting nothing. He's going to be close to nothing. It might be a penny. It might not even be worth doing it. He might be stuck in a situation where you just have to hold. You don't even really have the option of selling a covered call at or above your cost basis. So he might have to take, he has two choices now. There's only really two choices. Well, okay, there's three. There's three choices for him. He could either just cut his losses, sell out completely, not wait, and just get rid of it. Okay, not probably the best choice. Next choice is he could probably reach up halfway and sell the 37, 38 covered call to get some premium. And then if it starts moving up, he has to roll it forward and then possibly get out of the trade later. Okay. The other thing you can do is just wait. Just hold the stock and just wait and back to buy and pray method, which is the reason that we don't want to go into the wheel strategy. You know, we want to get away from the buy and pray method. We want to get away from being the normal people that just buy shares, hold them, and then pray that they go up. We want something that gives us premium every single month. That's why I know maybe I didn't use the best analogy or the best scenario here for why we start with cash covered puts. But every dollar safer, especially every $5, but every dollar safer is going to enable you to have multiple options to be able to sell covered calls in the future for cheaper. Let's put a number to this. Let's pull up a chart here, just so I can give you one more quick example of what I'm talking about. This site is wallmine.com. I like it because it presents a lot of information right there in front of you. So let's come back to here. Okay, and let's say that it was trading at $30 a share, and you decided that you're going to start wheeling Carnival Cruise Lines because the vaccine is coming out, everyone's getting vaccines, everyone's going on cruises now, everyone's been cooped up inside, and the companies, the cruise companies are back online. They're starting to be operational, so you are very bullish about these. So you decide, okay, I'm going to buy 100 shares at $30 a piece, and then I'm going to sell the covered call at $35, and you're going to make a couple dollars, okay? Well, guess what? It just dropped. It just came down. Now it's $28 a share. If you had sold the put at $28 a share, you wouldn't be assigned yet. You get what I'm saying? Even though, let's go $5 each way. It's at $30 a share. You reach up and sell a covered call for $35, or you sell a put at $25. If you sold the put at $25, you're still making money. And what I'm trying to point out here is that when you sell a cash secured put, you're basically guaranteeing yourself that you're not going to be buying shares at the height of the market. You're not going to be buying shares at the most recent peak. You're immune from this problem. When you start the wheel with a cash secured put, you cannot possibly have the highest price. You get what I'm saying? Right? With my strategy, I always aim to be 10, 15, 20, or 25% below the current price when I sell a put. And what this means is that I'm guaranteed to be 10, 15, 25% lower in my cost basis if I ever do get assigned the shares. Whereas if I started with a covered call, I would not have that guarantee. I would only have my premium, right? So if I got 4% in premium, I'd only be 4% below the recent high if that stock started to tank. That's why I always start with a cash secured put when possible. But I have looked back at the last 12 months, since June, post-COVID, and thought to myself, if you were double wheeling this, meaning you did a cash secured put and a covered call at the same time, you would have a much higher return, but you'd be giving up some of that safety. Basically, you'd be cutting your distance in half. For every cash secured put you sold, you still add the premium from the covered call, but you'd be giving up half the distance of your cash secured put. And I'm not sure if that's what I want to do moving forward, but I was just thinking, after that major downtrend that we had for COVID, if I had been doing that, it would have made more money. So something to consider, but remember, what we're talking about here is safety and goals, okay? You would not choose to start the wheel with a cash secured put for safety reasons. It's not safer. It has higher potential because you get to lock in some appreciation and premium. When you're doing cash secured puts, all you get is premium. You don't get any of the appreciation. But if you want to be safer, you always start with the cash secured put. All right, let's go take a look at some stuff here today. Now I got this list from Facebook. Somebody else posted it. He pulls them off of Thinkorswim. And I'm going to use his today because I want to see stocks that I don't normally look at. And that's our goal today. So let's see what we see. What is the LSE? By the way, if you guys have any questions, let me know in the live chat. And let me know if that explanation helped you. Did I make sense? I felt like I rambled on a little bit there and I tripped over some of my words. But did you understand what I was teaching? Do you understand that a cash secured put is always going to be the safer way of starting a wheel strategy? Let me know in the comments in the live chat how well I explained it, or if I need to do it again another time in a better way. Energy technology company in the U.S. The company offers energy storage solutions with Athena, an artificial intelligence-powered analytics platform to optimize energy use by automatically switching between battery power, on-site generation, and grid power. This reminds me a little bit of CleanSpark. CleanSpark Tesla has a autobidder thing, and then CleanSpark has some of this type of equipment. Oh, excuse me. There we go. So STEM, they're saying we can sell the $30 put, It's currently trading at 35. We get a downside protection of 8.1%. I think I put that in there. Yep, there. And then we get, you can make 6% a month. If you did this, you're only getting downside protection of 8%. I think that's calculated without the premium inside. Let me take a look at this. Yeah. So this is only counting, no, it is counting the 6% here. So it's 6% also with that. Okay, not a lot of downside protection on STEM. Not a company I've not really heard about. And it is not showing up in my Wallmine. All right, let's go to the financials on Yahoo. Well, it was saying sell the 30 for $1.60. Yep. We have open interest of 11,000, 15,000 on the 25. Total assets 384. Total liabilities 293. That is not a good ratio. That is 76%, and as you might know from watching my previous channels, that puts me in the no category. Once they get over 70%, it becomes much harder for them to borrow money when they need it. That's fine as long as they're going to be profitable, but if they hit any bumps in the road and they need to raise cash, they're not going to be able to. Or at least not easily. I think I did look at TTD a little bit. I was interested in what that was before. Operates as a technology company in the US and internationally. They're near Los Angeles and Ventura. The company operates a self-service, cloud-based platform that allows buyers to create, manage, and optimize data-driven digital advertising campaigns in various ad formats and channels, including display, video, audio, in-app, native, and social, and on various devices such as PC, mobile, and connected TV. So on all the smart devices. I'm already making trades on Digital Turbine and apps is Digital Turbine. So this wouldn't give me a new sector that I want to be in, but it is something that I can reach out and compare to apps, APPS. Oh, look at this cliff. Thought something was really weird about this chart because it was showing the 800 here, and it wasn't really showing this gap down. I wonder if they did a reverse split. No, reverse split would cause it go up. I wonder if they did split shares, or if things just actually went really, really bad for them. Come read this full article if we can about the 50% drop, see what happened there. Looks like that started in May. I'm not going to watch the video right now, but it looks like they were based on a lot of web cookies for their user tracking, and they're saying that cookies are going away, and so they're going to switch to some sort of opt-in service. No one's really going to opt in to have advertisements in their face if they can avoid it. Might be a play for this company to come back in some way, but for now, I'm just going to add it to our watch list here, and we'll take a look at it another time. So I want to keep going. We've got only 8 minutes before the opening bell. Thank you guys for hitting like, subscribe, and the bell on YouTube so that you can get our notifications of when we're doing videos and any videos that we have coming out. And I'm going to be trying to do more of the sort of not live, I guess, recorded videos, scripted videos, where I do more of the teaching without having it be in a live segment. Live is more fun, but I get more views and more discoverability with scripted videos, I guess. Okay, therapeutics I'm not interested in, fuel I'm not interested in, health not interested in. What is this? Clinical stage, biotech. Not interested in biotech and health until after COVID pumping is over. Maybe it is time to start getting into it, but I can wait for a return to normal on pharmaceuticals, therapeutics, and vaccine companies. And Fibrogen, GoTo, GoPro. I did look through some of these the other day, but not all of them. Lamb Weston Holdings produces, distributes, and markets value-added frozen potato products worldwide. I like how specific that is. Frozen potato. Huh? It's in Boise, Idaho, of course. 4 segments: global, food service, retail, and other. The company offers frozen potatoes, sweet potatoes, commercial ingredients, and appetizers under the Lamb Weston brand, as well as various customer labels. Under its own or licensed brands such as Grown in Idaho and Alexia and other licensed brand, as well as under retailers' own brands. Okay. Surprised they didn't mention French fries with all the frozen potatoes. That's what we mostly bought. We were buying frozen potatoes. We were buying French fries ready to throw into the oven. $78 a share. I don't think I have Celsius trades going on soon. That's going to give me exposure to food and beverage through the energy drink sector. But being in the frozen foods might be more diversified for my sectors. Although their revenue quarter over quarter is down 4%, year over year down 11%. That's not what I like to see. So I don't think I'll be doing anything on this, especially when we look at that debt, right? 3706 divided by 4158. And you guys might wonder, why do I treat the debt so seriously? Why don't I spend more time on the technicals? Because I'll tell you what, this is the fastest way to eliminate a company, right? There's over 9,000 companies for us to invest in. I've tried frontwards to backwards, backwards to front. I've tried doing technicals first. I've tried doing fundamentals and looking at all sorts of information, and then look at this, and then look at the profile, and then look at the insider trading. One of the fastest way to figure out what the heck is going on is to scroll down here on your balance sheet and your income statement. Total assets, total liabilities. If this is over 70%, just kill it. Move to the next one. There's 9,000 stocks to go look at. If you see that they've got, they're running negative on their income statement, on their cash flow, okay, and they've only got 2-3 quarters in cash, again, kill it, move on, unless they got really low debt, right? If they got 10%, 20% debt, and they've only got 3 quarters in cash, they're just going to raise capital. It's not a big deal. You have to decide whether they're a good growth company or not. This company is making money, but they're down revenue quarter over quarter, year after year. So we should probably see the stock continue to decline. I mean, obviously that's why you have it going down right now. Earnings came out July 28th, or coming out July 28th, so you're going to get a little bit of over a month if you decide to make a trade on this right away. This is a dividend paying company. They pay $1 per dividend, $1 per share. That's, of course, over the year. So over the year, you'll make 1.19%. Anyway, something that maybe consider, but I'd basically want for the revenue quarter over quarter to turn positive before I was really interested in this company. And then again, didn't I just say the debt was really high? Right, 89% debt. I'm just not going to take a pass on that and not waste my time, because I got to spend my time looking at other companies that are going to be a better deal right now. I want a deal that's today. We got 3 minutes before the bell. Don't forget to hit that like and subscribe, and share the channel with your friends and family. I try and keep this channel good for both beginners and for experienced people. So I spend the first 15 or 30 minutes talking about just sort of education and mindset. Even if you're experienced, that type of stuff might just be what you need to hear again. Sometimes you forget the basics or why we do things, or you get a little bit too crazy. And if you heard it before, then it's okay. You just tune it out while you do your research. And then we go look at stocks, because that's what experienced people want. I'll tell you what, new people always want the stock picks, but they don't want to pay for it. If you really just want to skip the work, you don't want to do any of the work or any of the research, and you just want to be told what to trade, you should pay for a good service that you trust and use, like theoptionsoracle.com. They do the research. Okay, don't go and get that stuff for free, because you won't know when to rebalance, when to close early. You won't know what to do because you haven't done the research and you haven't paid for somebody that's reliable. All right, so be careful out there, guys. So what I'm basically saying is the new people really benefit from this channel in the first 15 to 30 minutes, because I go over mindset and strategy and explain things. But what they really want is the picks, but they don't want to pay for the picks. Even though if you just want picks, you should pay for the best service possible. And if you're new, you shouldn't want picks right away. You should want to learn the process and understand what the heck's going on. But, everyone wants a shortcut. Macquarie Infrastructure Corporation invests in infrastructure, businesses that provide services to corps, government agencies, and individual customers, primarily in the U.S. Aviation, MIC, Hawaii, and corporate and other. So it does fuel delivery, aircraft hangar rental, and other services, de-icing services, landing, concession. Cool. So it's like travel without the travel. It's not subsidiary. Brain is not working. It's 9:30 at night for me. There we go. Opening bell is live, and we've opened up new stuff on BNGO. Oh, Mara and Riot are both down another $1 today. So cryptocurrency must be taking a bit of a hit. Yeah, Bitcoin is down another 4%, 20% over the week. Ouch. That's big. Good thing about Mara and Riot is as long as Bitcoin stays over like $6,000 a piece, they continue to make profit. But I probably should have checked CoinMarket and rolled those out, changed my strikes on those, or took those off the board before that went through. When did it start dropping? It's been on a downtrend probably the last 6 days. June 14th, literally the last 7 days. Started downturning on the 16th. Wants to climb back up, but just isn't going to get it. Alright, we might be eating it on those later. Might be holding and selling covered calls. AI down 57 cents. ARKG, Binjo, CLF, Disney. Most of everything is red today. Alright, let's sort by days. We've got nothing expiring anytime soon. That's kind of weird. It's weird now after having so much stuff expiring last week. I wish I could get that closed for 7 cents, but that's not really going to go through. But Space has got some big event coming out July 4th. Richard Branson is trying to beat, what's his name, Jeff Bezos. I almost said Bozos because that's what another guy calls him. Jeff Bezos in the space. So Bezos said that he was doing his at the end of July, and then Richard Branson says he's not waiting for the public one. He's going to go up on one of the test flights on July 4th, which is a really great date to pick it. That'll help drive up a lot of attention to it. Blue Origin raised $23 million in auction for a single seat on their first flight into space. I don't think it was a test flight. I think it's its first public flight into space after they've made sure everything's super safe and everything. But $23 million for a single seat. Obviously, it's because it'll be one of the first ones, and that'll be newsworthy. But I was looking at Richard Branson's or Virgin Galactic's models, and I think their projections were based on $250,000 per customer. So if you've got, I don't know how many seats they're going to have, but if you have 6 to 10 seats in there, $250,000 each, you make over $2 million every time they launch people into space. But when Blue Origin auctioned off a single seat for $23 million, it really got people excited, and we saw the price of space or Virgin Galactic shoot up in a big, big way, because that means that they're actually probably underpricing their premium service, right? Of putting people into space. At least for the first year, It's one of those things where it's really exciting and really good for publicity when you're one of the first few people to go up and do it, but it becomes less and less interesting and newsworthy. It becomes less and less valuable. I think Soldier Boy wants to go into space, as well as a few other artists. I personally wouldn't want to do it until a few years of of making sure there's no problems. It's the problem with being a trader. You become more and more risk adverse, right? It's 9:34. We've got about 11 minutes together. Felt like it's gone pretty fast, even though there's not much comments in the live chat today. Be sure to use that live chat unless you're driving. Then please don't use the live chat. Stay safe out there. But when you guys ask questions, when you guys ask me to look at stocks, it makes it more fun. And it shares the information. I can explain stuff to you that's more relevant, stuff that you're working on. Okay, good. Polly's come back up and is above my covered call. Got 25 days left on that. I think that was a roll. I think I had to roll that one forward, so I'll have to look at what my actual cost basis is. But Poly is Plantronics. I didn't expect them to come down and get assigned to me, but it happened. AI has not been going the direction that I thought they would. I did a credit spread on that, hoping that it would shoot up, but it did not. It's been a bit of a setback for me. Well, not much for me to manage because there's not much expiring soon, and things are not shooting up in price, so I can't really close them early. Tesla's still above 600 a share. That's good for me. I own a lot of Tesla, unfortunately under margin, which makes it risky if in case it does come down temporarily. Let's jump to our watch list here and start filling it in. Not the most exciting thing to watch, but you know what? Not enough people show this on YouTube, and so people get used to this, having all the answers, not knowing what to do, not knowing what the real work that goes into this is. There's so many people that get into cryptocurrency and stocks, and they never bother to do the work or learn how to do the work, and so they basically treat it like gambling, but they don't even know the odds on what they're gambling. XPEL is in the aftermarket automotive. Let's call it auto parts. If you guys are watching this on the replay, do be sure to check out theoptionsoracle.com as well as sens.org. One of them will help you get rich. The other one will give you a good place to put your money once you become rich. And don't forget to hit that like and subscribe. 82.7 and 36.5 on the revenue. Just forgot it. 82.7, 36.5. See, there's a decent debt ratio. 35.3 by 95.3. It's 37%. They are cash flow positive. They have 35 million cash on hand. They have not lost money since at least 2018. It only goes back 3 years on a wall mine, but that's enough for me to know that the runway is 100, meaning that they're not going to have to raise capital or dilute shares anytime soon. Earnings come out 9th of August. Got 49 days till that comes out. Although there was not enough ROI on this, even though it had an IV of 69.2, so we don't need to spend any more time on that for now. Yeah, never could find this stock. Take that one out of here. Five more minutes before I'm signing off. Now is the perfect time if you have any questions, any stocks that you guys are looking at. Happy to go over that with you right now. I really like these new columns I put into my spreadsheet so that I'm tracking the at-the-money ROI. And then my plan is to update this month over month and be able to flip back to the previous months and see how it's changed, to see if there's a better entry point. But to have all of it right here on one screen, the price, the revenue, basically my fundamental analysis as well as the setup. I like that it's all going to be right here. And one of the things I added to this was a margin calculator to see which stocks are giving me the best margin. And I'll be putting that into play in the future. I've been experimenting with doing margin stocks, doing cash secured puts on companies with high margin for lower yield but multiplied by the margin effect. Obviously, there's some additional risk there. If the market starts to tank, the market risk could be a major setback if it leads to a margin call, of course. So that has to be planned for and experimented with. 36.8 and 27.7. 36.8, 27.75. It's an okay debt ratio, 1740. Oh, no, not as good okay as I thought it was. I thought it was lower than that. 63.2% debt ratio. Don't like it above 60. Profitable company and a lot of cash on hand. These guys have a runway of 100. That's good. Revenue growth is great. Quarter over quarter is great. It's just the debt is bad. I hope they pay down some debt. I like to give these guys a higher rating. They're at least a 4 if they pay down their debt. Just going through some of our scans and stock lists. I've already done a lot of the work over the weekend. It was options expiration week on Friday. So there was a lot of stuff to look at, a lot of work over the weekend. And I've got that done, which is why you're not seeing me go through too many stocks today. I've already done most of them that I wanted to do. Here's one I haven't done the analysis on that might be interesting. HYFM cannabis. Hydroponics. Currently trading at 56 even. Revenue, not available, not available. It's a very small cap company. Market cap, well, market cap's 2 billion, but they've only got 300 million in assets. 24.8 debt. Not profitable. They could lose up to 40 million a year if they repeat 2019. They've only got 62 in the books. That still gives them 6 quarters, which is okay, but not the best. And I don't know their revenue projections. Sorry, I don't know their revenue history, and I don't know the revenue projections, both of them. Alright guys, it's 9:45. I've done most of my work. I've opened new positions this week. We looked for things to manage. We talked about mindset, goals, and how to pair strategy to the goal. If you guys missed out on that, rewind back to the beginning, watch the replay, check that out. And I want to thank you guys for being subscribed. And do check out, if you're already rich, check out sends.org or consider donating to it monthly. It could be the best investment by giving your money away to solve aging. Hey, if it solves your aging, that'll be the best investment you've ever made. The other one that check out is theoptionsoracle.com. They do market signals, so you don't have to do your own research, or you could just use them to accentuate or expand your own research to find stocks that you might not have traded if you hadn't have had their help. All right, guys, that's it for me. See you on Wednesday.